Welcome to Vskills YouTube channel. In this video, you will learn about the top interview questions for portfolio analysis. So, let's get started. Question number 1. Explain the types of asset allocation. The answer is, the types of asset allocation are strategic asset allocation, constant weighting allocation, tactical asset allocation, dynamic asset allocation, insured asset allocation, integrated asset allocation. Question number 2. What is the portfolio management process? The answer is, the portfolio management process is a continuous method of managing a client's asset portfolio. The process has several components and subcomponents that ensure a portfolio is personalized to fit the client's investing objectives while staying within his budget. To preserve the risk-return trade-off, portfolio managers must devise particular portfolio management strategies. Question number 3. What is the role of SEBI in portfolio management? The answer is, the Securities and Exchange Board of India is India's primary securities market regulator. The Securities and Exchange Commission in the United States is SEBI's counterpart. Its declared goal is to protect the interests of investors in securities, to promote the growth and regulation of the securities market, and for matters related with or incidental to the securities market. Question number 4. Explain the structure of SEBI. The answer is, the chairman of SEBI is nominated by the Union Government of India. 2 officers from the Union Finance Ministry will be a part of this structure. 1 member will be appointed from the Reserve Bank of India. 5 other members will be nominated by the Union Government of India. Question number 5. What is asset allocation? The answer is, the long-term asset mix is the key to successful portfolio management. Stocks, bonds, and cash, such as certificates of deposit, are examples of this. Others, such as real estate, commodities, and derivatives, are referred to as alternative investments. Asset allocation is based on the knowledge that different assets do not move in lockstep and that some are more volatile than others. A well-balanced portfolio safeguards against risk by incorporating a variety of assets. Question number 6. Explain rebalancing. The answer is, at regular periods, usually in a year, rebalancing is performed to return a portfolio to its original target allocation. This is done to return the asset mix to its original state when market fluctuations throw it off. For example, a portfolio with a 70% stock and 30% fixed income allocation could transition to an 80/20 allocation after a prolonged market rally. Although the investor has made a profit, the portfolio now contains more risk than the investor can bear. Selling high-priced stocks and investing the proceeds in lower-priced and out-of-favor equities are referred to as rebalancing. Question number 7. How does passive portfolio management differ from active? The answer is, passive management is a long-term technique in which you set it and forget it. Indexing, also known as index investing, tries to replicate the performance of a specific market index or benchmark by investing in one or more exchange-traded index funds. Active management entails actively purchasing and selling individual stocks and other assets in order to outperform an index. Closed-end funds are typically managed aggressively. Question number 8. Explain the common faults in revision. The answer is, the common faults in revision are not understanding the investment, too much investment, turnover, attempting to time the market, failing to diversify, waiting to get even. Question number 9. What is portfolio revision strategies? The answer is, portfolio revision is the process of altering the securities mix in a portfolio. Portfolio revision is the process of adding new assets to an existing portfolio or modifying the ratio of funds invested. Portfolio revision is the sale and acquisition of assets in an existing portfolio over a specific period of time in order to maximize returns and minimize risk. Question number 10. How do benchmark portfolios work? The answer is, professional investment managers create benchmark portfolios with the goal of achieving the investor's investment objectives. Benchmark portfolio management that is effective takes into account essential elements such as the investor's investment style, risk appetite, and predicted portfolio returns. In order to select the proper portfolio, calculate the right amount of asset allocation, and find the relevant benchmarks, the process of setting benchmark portfolios necessitates market experience. In the event of unexpected market activity or exceptionally high or low volatility, benchmark portfolios may benefit from professional adjustment. When a manager succeeds in managing risk through diversity, it is also a sign of excellent benchmark portfolio management. Question number 11, what are barbelled strategies? The answer is: the barbell method is utilized to profit from the greatest features of both short and long-term bonds. Only very short-term and extremely long-term bonds are purchased in this method. Bonds with longer maturities have greater interest yields, whereas short-term bonds provide more flexibility. The liquidity provided by short-term bonds allows an investor to change possible investments every few months or years. If interest rates rise, an investor can reinvest capital in bonds with higher yields than if the money was invested in a long-term bond. Question number 12, explain laddered strategies? The answer is: this investment method allows an individual to spread out bond investments with varying maturity dates across time. Spreading investing cash over a variety of different bonds at different dates and at varying interest rates gives an investor additional options. This precludes a single lump sum of money from being invested in a bond for an extended period of time, restricting prospective income and preventing an investor from profiting from interest rate increases. Question number 13, what is bullet strategies? The answer is: a bullet investment strategy may be the best way to go if an investor knows he or she will need a specific quantity of funds at a specific moment in the future. This method advises staggering bond purchase dates for bonds that all mature at the same time. Investors can more effectively seek for securities with higher interest rates by staggering their bond purchases. Investors may be able to obtain a possibly more favorable inflow because all of the bonds have the same maturity date. However, because the investor is staggered in his bond purchases, there is a chance that interest rates will decline during the bond buying period. It's critical to keep a careful eye on the interest rate environment if you want to execute this method successfully. Question number 14, what is Sharpe ratio? The answer is: the Sharpe ratio is a popular risk-adjusted return metric. The Sharpe ratio is the average return obtained over a risk-free investment, such as a government bond in the United States. A greater Sharpe ratio denotes a better risk-adjusted return overall. These metrics are frequently published by managed investment funds and index providers alike. Question number 15, what systems have you developed to reduce errors in work? The answer is: whether it is rain or shine, as a policy I always ensure that whatever task is assigned get reviewed at least 3 times over and referenced again before it goes for execution. Question number 16, who is a custodian? The answer is: custodian is an independent organization that has the physical possession of all securities purchased by the mutual fund, and undertakes responsibility for its handling and safekeeping. For example, Stock Holding Corporation of India Limited is the custodian for most fund houses in the country. Question number 17, what are the SEBI regulations for portfolio managers? The answer is: the SEBI regulations for portfolio managers are: minimum listing requirements for new companies. Minimum requirements for companies delisted by BSE seeking relisting on BSE. Permission to use the name of BSE in an issuer company's prospectus. Submission of letter of application. Allotment of securities trading permission. A requirement of 1% security. Payment of listing fees. Question number 18, what is typically higher, the cost of debt or the cost of equity? The answer is: the cost of equity is always higher than the cost of debt. Furthermore, unlike lenders, equity investors are not guaranteed to receive fixed payments, hence the cost of equity is higher. Also, interest is considered an expense, debt is less expensive. In a company's capital structure, debt is also given priority. As a result, in the event of a liquidation or bankruptcy, debt holders are paid first, followed by equity investors. Question number 19, what does WACC mean? The answer is: WACC is an acronym for Weighted Average Cost of Capital. It is a proportional weighted calculation of an organization's capital. It accounts for all sources of capital and considerations such as depreciation, tax rates, debt, and equity. Question number 20, what is capital asset pricing model? The answer is: the capital asset pricing model is a mathematical model that estimates the value of a company's assets. Its purpose is to calculate the projected return on investment. It can be used to calculate the discount rate for a company's cash flows. Question number 21, what makes a good financial model? The answer is: building a financial portfolio necessitates numerous practices. The best financial model is one that recognizes all of the company's key drivers. It is always precise and accurate. The model should be able to handle dynamic scenarios with built-in error checking and analysis. Question number 22, explain equity portfolio management. The answer is the planning and implementation of diverse ideas, processes, and tactics for beating the equity market is referred to as equity portfolio management. All investment analysis has one fundamental goal: to make investment decisions or to advise others on how to make their own investment decisions. Question number 23. What are the types of portfolio management? The answer is, the types of portfolio management are active portfolio management, passive portfolio management, discretionary portfolio management, non-discretionary management. Question number 24. Define portfolio plan. The answer is, a portfolio plan is a written and visual representation of the portfolio's components, main dependencies, estimated timelines, and important deliverables, as well as a description of how the portfolio will be managed. Cost and benefit timelines, critical hazards, and major stakeholders are examples of supporting assessments. Question number 25. What is bond ratings? The answer is, a bond rating is a method of determining a bond's creditworthiness, which corresponds to the cost of borrowing for the issuer. Bonds are often assigned a letter grade indicating their creditworthiness in these ratings. Standard & Poor's, Moody's Investors Service, and Fitch Ratings Incorporated are private independent rating services that assess a bond issuer's financial soundness, or its ability to pay a bond's principal and interest on time. Question number 26. What is portfolio diversification? The answer is, diversification of your portfolio is a straightforward notion. In essence, it refers to the strategy of spreading your money over a variety of assets and asset classes in order to reduce your overall risk. If you put all of your money into a single asset, for example, a market downturn might wipe out your entire investment. Your portfolio's volatility can be reduced and your returns smoothed out with an investment portfolio diversification approach. Question number 27. Define Markowitz model. The answer is, the Markowitz model serves as a theoretical framework for analyzing risk and return, as well as their interrelationships. He calculated risk using statistical analysis and employed mathematical programming to choose assets in a portfolio in an efficient manner. The concept of efficient portfolios arose from his theory. The highest return for a given level of risk, or the lowest risk for a given level of return, is predicted from an efficient portfolio. Question number 28. What are macroeconomic variables? The answer is, macroeconomic variables are indicators or primary signposts that indicate the economy's present tendencies. To perform a successful job of macro-managing the economy, the government, like all specialists, must study, analyze, and comprehend the primary variables that define the current economy's behavior. Question number 29. Explain the market forecasting tools. The answer is, marketing forecasting models are a great method to anticipate client preferences and come up with fresh strategies to differentiate yourself from the competition. The greatest way to gather the most effective and comprehensive data to improve marketing efforts is to use practical forecasting models. Buyer surveys, business intelligence tools, sales data, test marketing leading indicators. Question number 30. Explain chaos theory. The answer is, chaos theory is an interdisciplinary theory that states that there are underlying patterns, interconnection, continual feedback loops, repetition, self-similarity, fractals, and self-organization inside the apparent randomness of chaotic complex systems. Deterministic chaos, or just chaos, is the name given to this type of behavior. For more such videos, subscribe to our channel.